So shall we start?
Yes, ma'am.
Okay.
We are live actually.
Okay. Wish you all a very good morning.
Very bright morning to all the CA students who have joined this morning session on SFM, and a very warm welcome to our CA Shanti ma'am, who is going to be our faculty for the Revise and Recall Marathon conducted by SIRC of ICAI. This is Sushmita here, and I'll be your host for this session. Before I call upon Shanti ma'am, I would like to introduce her for the benefit of our audience. CA Shanti ma'am is a qualified CA who also secured an All India rank during her intermediate days. Apart from that, her educational accomplishments include CWA, CIMA, Advanced Diploma, PGDTFM, that is Postgraduate Diploma in Treasury and Forex Management, etc. She has over 25 years of teaching experience in diverse subjects such as Cost and Management Accounting, Financial Accounting, Strategic Management, SFM, Strategic Cost Management, etc. She is currently a visiting faculty at SIRC of ICAI Chennai and Grey Matter Academy Chennai. Apart from that, she has also been a visiting faculty at multiple branches of ICAI, such as Ernakulam, Kozhikode, Mysore, Thiruvananthapuram, etc., to name a few. And the list goes on and on. Thank you, ma'am, for being a part of us today and accepting to be the SFM faculty. We look forward to the session. Students, in case you have any doubt, please post it in the YouTube queries box, and I'll ask her the same towards the end of the session. The virtual stage is yours now. Thank you, ma'am.
Okay. Thank you very much for the kind introduction. Shall we get started with the class? Now, as you know, can you see the screen being shared?
Yes, ma'am.
Okay. Now, what is it we have in our agenda? Let's see. First, of course, the question paper pattern, then how you manage your time in the exam, then the important topics, problem topics, as well as theory topics, and the revision of chapters, important chapters, and of course, any query you have, and I will answer those queries. Let's just get started. Of course, I'm sure all of you know the question paper pattern, but still, I thought that would be a good beginning to start. What is it? As you all know, question 1 is compulsory. You are expected to answer any 4 from questions 2 to 6. All questions are 8 plus 8 plus 4. That is, they have 3 subdivisions, A, B, and C. And A and B, 8 marks each, and C, 4 marks. Sometimes, very rarely, they make it 10 plus 6 plus 4, which means subdivisions A and B in every question would be problems. That makes it 12 problems of 8 marks each, which means in your paper, 96 marks is problems. Then you have 7 theory questions of 4 marks each, making it 28, and therefore the whole paper, including the choice question, is for 124 marks. You might wonder, when you have only 6 questions, how is it you have for 7 theory questions? The thing is, in the last question, there is a limited choice. You have in the theory question, you have either or, so that's why you have an additional 4. So out of the 124 marks, 96 is problems and 28 is theory, 12 problems and 7 theory, of which of course you are expected to answer for 100 marks. Now, with regard to time management, what is it? I would suggest the 15 minutes reading time which you have. Decide the question which you are going to leave in choice. Do not read the compulsory question there. Why am I saying this? This is because anyway you have to answer the compulsory question. And mostly the compulsory question will be such that it is of a high standard. So the 15 minutes, if you spend time in reading the compulsory question, you will be spending a lot of time, but you won't have time to decide which question to leave in choice. The 15 minutes should be spent on looking at the other questions where you have a choice to leave, and therefore do not read. Anyway, you have to answer the compulsory question. So there is no point or purpose in reading the compulsory question during the reading time. Read the other questions, see which is the question you would like to leave in choice, and others, of course, you have to answer. See, sometimes what happens, or not sometimes, most of the time what happens in our exam, we will know 2A and 3B, like that. So it takes some time for you to have a trade-off, balance it, and decide which one is to be left in choice. Spend time on that during reading time, deciding what you want to do, and also the order in which you would answer the questions. My suggestion to you would be, see, out of the 6 questions, you have to answer 5. My suggestion to you during reading time, you would have decided which are the questions you know best. So answer the 2 questions which you know best within the first 1 hour, so that minimum guarantee of 40 marks is in your pocket. Then answer the compulsory question. Maybe you could take even 45 minutes for the compulsory question, even though that is also 20 marks. Don't go by exactly for every 10 marks, 18 minutes. It never works that way. Take the questions you know best, answer within the first 1 hour. So 40 marks you have answered. Next 20 marks, you can even take 45 minutes, 50 minutes, not an issue. And if in case there is a particular sub-question which is going to take a long time and you're not very sure, you can always leave sufficient space, because you know all parts to a question has to be answered at one stretch. You can leave sufficient space, then answer the other 2 questions which you have chosen. This would be my suggestion as to how to manage your time during the exam. Then one very important thing with regard to reading a problem question. Not just for SFM, for any paper, this is equally applicable. What is it I'm suggesting? Never start reading the question from the beginning. That's not a good way to read a question. What you should do, you should first read the requirement. Only if you read the requirement, you know what is it you're looking for in the main question. So I would suggest that any question you take in any problem paper, read the requirement first. And once you have an idea as to what is it you should answer, then if you read the main question, your mind will automatically analyze and pick up whatever you have to work on. So that would be a good way to read a question. Then coming to the problem chapters, important problem chapters, I have grouped them into 3. Chapters which concern investment. Your chapter 4, which is about securities, your chapter 5, which is about portfolio management, and your chapter 7, which is about mutual funds. You would observe that whether it is equity or bond or portfolio management of mutual funds, we are talking about investment. So I have grouped chapters 4, 5, and 7 together under investment. Next, like you have equity valuation and bond valuation for portfolio management, for corporate acquisition and restructuring, you have what is known as corporate valuation. So I have grouped these 2 chapters together, your corporate valuation and mergers and acquisition. This will form the second block. And then risk management. In risk management, I've included Forex International Finance also. So your other block would be chapters 8, 9, 10, and 11. Chapter 8, as you know, is derivatives, 9 is Forex, 10 is international financial management, and 11 is interest rate risk management. These are the important problem chapters. Now, when you study also, when you revise also, you should group them like this and then revise so that you get the whole picture. Then coming to the important theory chapters, chapters 1, as always, everywhere, you know, chapter 1 will be the introductory chapter for any subject. That will be a theory chapter only. So this first chapter, that is introductory chapter, your financial planning and corporate strategy, that is an all theory chapter. Again, chapter 6, securitization, is an all theory chapter. And chapter 14, startup finance, is an all theory chapter. Predominantly your theory questions come from this. We already saw 7 theory questions which you will have, each one carrying 4 marks. So chapters 1, 6 and 14 is what you'll have to look to for scoring those theory marks. And as you know, you do not have an all theory question. You have a theory question as part C with every question. So there is no way you can get away from theory. You have to concentrate on this. And then chapters 2 and 3 are sort of mixed, predominantly theory, but some problem also could be asked. In risk management, very small part of problems. Even when you talk about risk management, they could ask you about value at risk. And then in security analysis, they could ask you for testing efficient market hypothesis and things like that. So that's it. Now, let us get started. Now, any questions you have, you could post it in YouTube and they will tell me at the end of the session where I can take those questions. Now, as I was telling you, we will be dividing it into 3 blocks, the problem areas. Now, you know, we have 3 hours for revising the entire subject. So obviously, we will not have the time to solve any problem. But what I thought, see, the problem starts in a problem paper when too much importance is given for computation and concept is neglected. So what I thought, you will be benefited if I take each of these problem areas and tell you what are the important concepts and which are the areas where there is a possibility of committing a mistake so that you avoid those mistakes. This was my idea when they said marathon revision. So I think this way it will be useful for you rather than taking some handful of problems and working it out. With regard to presentation, I will display a couple of solutions to you to highlight to you how the problems have to be solved and presented. So first, let me take up the chapters which I have clubbed into investment. What are the chapters I've clubbed into investment? I've clubbed chapters 4, 5 and 7. Chapter 4 is about bond and equity. Chapter 5 is about portfolio management. And chapter 7 is about mutual funds. All these form part of investment decisions. Now, when it comes to bond, what is it we'll have to look at? Any investment, there are 2 factors with which you are concerned. What are those 2 factors? Return and risk. So, first, what is the risk we are looking at when we look at bonds? There are various types of risks associated with bonds. The first risk which an investor is interested while looking at a bond is the default risk or credit risk. What do we mean by this? Is interest payment and principal repayment as per schedule. This is what I am interested. Interest payment and principal repayment should be there. That refers to the quantum as per schedule, because we are very much interested in time value of money. It has to be at the promised time. That is also important for me. Default risk or credit risk is the risk that the issuer will not be able to satisfy with regard to timely payment of interest and repayment of principal. Why is there a default risk? Default risk can arise due to business risk, which is what you are trying to manage strategically in strategic management. It can be due to financial risk, which is what we are handling in strategic financial management. It could be because of operating risk, which is what you look at in strategic cost management. Now, whenever we talk about risk, we also talk about risk-free securities. Government securities are assumed to be risk-free. That doesn't mean they are free of all risks. Government securities are assumed default risk-free, and hence it is taken as risk-free rate. So companies which have a higher credit rating will have a lower default possibility compared to companies with lower ratings. So when we talk about what is the return that is required from a bond, we would consider the risk-free rate, and we would also consider the risk premium, which is based on the credit rating, which is again based on the default risk. Is this the only risk associated with bond? Definitely not. You have what is known as marketability and liquidity risk. What is this marketability or liquidity risk? If default risk is because of the issuer, his business risk, his financial risk, and his operating risk, marketability and liquidity risk is to do with infrastructure. Is there a well-developed bond market so that in case of need, the investor is able to exit? That is what is captured in marketability or liquidity risk. Then we come to the most important risk with regard to bond, which is interest rate risk. What do you mean by interest rate risk? Bond investors are subject to interest rate risk on two counts. One, the reinvestment of periodic interest, and two, the capital gain or loss on sale of bond at the end of holding period. So, when the interest rates rise, periodic interest can be reinvested at a higher rate, and hence there is a gain on reinvestment. When the interest rate rises, the market price of the bond will come down because the going rate has increased, and hence there will be a capital loss. So what do we know? Interest rate risk is because of two things: reinvestment risk and price risk. If you have a benefit in one, you will have a loss in the other. If you have a gain on reinvestment, you will have a capital loss. If you have a reinvestment loss, you will have a capital gain. So your interest rate risk is made up of reinvestment risk and price risk. There is also another thing called call risk, which is there in case of callable bonds. So when we say risk of a bond, there are so many things involved in risks. Then we will be considering yield. Again, in the exam, the problem will mention only yield. But what yield are they referring to? We need to know. There are different types of yields. First, discount yield. What is discount yield? Discount yield is the rate of return of a couponless security. If you have a zero coupon bond, if you have a money market instrument, you do not have a coupon attached to it. Therefore, the return for the investor is the difference between the issue price and the redemption price. So that is what we mean by discount yield. Then we have what is known as a nominal yield, also called coupon yield. What is that? That is a stated rate of interest on the bond. It is interest expressed as a percentage of face value or par value of the bond. Now, we are not very happy with this yield. As the name itself says, it is a nominal yield. The yield is there for namesake only. Why are we saying that? Because yield means return. Return should be whatever you get in addition to what you have invested on the investment amount. Nominal yield, see that my return is made up of two components, income and capital appreciation. Nominal yield considers only the income component of return. It does not consider the capital appreciation. Also, the investment amount, which is the current market price, that is not considered. Only face value is considered. Therefore, we are not interested in nominal yield or coupon yield. So, an improvement over this, we have what is known as current yield. Now, when you read a question, you have to be careful as to which yield they are referring to. What is current yield? Current yield represents the return an investor would get if the bond is purchased at the current market price and held for a year. You know, all returns will be annualized and will be expressed as a percentage. They are annualized for the sake of comparability because different investments will have different holding period. They are expressed as a percentage because the investment amount in different investments is different. Therefore, always yield or return should be expressed as a percentage and should be annualized. So, what is current yield? Current yield is annual interest divided by current price of the bond into 100. Now, one problem which we had with nominal yield, namely that it doesn't consider the current market price, is sorted out here, but still there is a problem in that only the income part is considered and capital appreciation is not considered. Then we have what is known as yield to maturity or redemption yield. The yield to maturity or redemption yield of a bond is the internal rate of return earned by an investor by purchasing the bond at the current market price and holding it till maturity. If it is capital investment, we call it internal rate of return. If it is equity investment, we call it return on equity. If it is bond, we call it yield to maturity. So, yield to maturity or redemption yield of a bond is the internal rate of return earned by an investor by purchasing the bond at the current market price and holding it till maturity. Now, when yield to maturity is given in the problem, see, our idea here is to relate the concept to the questions that will be asked in the exam. How to identify which yield they are referring to. If you use yield to maturity, then see, whenever I talk about value, whenever I talk about price, it is about the discounted cash flow, discounted future cash flow. If I use yield to maturity to discount all the future cash flows, I will get current market price. So I can look at three situations. If the current price is equal to the maturity value, I can say yield to maturity is equal to coupon rate. If the current price is less than maturity value, I can say yield to maturity is greater than coupon rate. If the current price is greater than maturity value, I can say yield to maturity is less than coupon rate. Because I am going to use, we have already seen yield to maturity is like internal rate of return. If I want the current market price, which from the point of view of the investor is the investment which he is making, that is the present value of cash inflow. We know when we use IRR, the present value of cash inflow and present value of cash inflow will be equal. What is the cash inflow? Interest, periodical interest is a cash inflow. Maturity value is the cash inflow. So if I use yield to maturity, that rate, and discount the periodic interest payments and the maturity value, I will get the current market price. Of course, if you have interest paid annually, you can do annual compounding or discounting. If interest is for any other period, say it's paid semi-annually, then I need to halve the interest rate and I need to double the number of periods, because the nature of the cash flow will determine the nature and timing and frequency of the discounting or compounding. Now, yield to maturity, why do we require it? To find the current market price. What am I going to do by finding the current market price? I'm going to compare it with value and then take a decision. So to get value, what should I do? I should use required yield. Required yield. See, there are clear differences between yield to maturity, required yield. So you need to be careful in reading the problem as to what is it they are referring to. Required yield is the minimum yield which the investor requires from a bond. As I already mentioned, it has two components: risk-free rate, which is determined by the yield on government securities; risk premium, which is determined based on credit rating of the instrument. So required yield is used as a discount rate to find intrinsic value or fair value or equilibrium price of the bond. If we are to draw a parallel in equity, required yield for a bond is similar to cost of equity. Required yield for a bond is similar to the cutoff rate, that is a weighted average cost of capital or risk-adjusted discount rate in capital investment. Now, there is also another concept called realized yield. Realized yield is the return earned by the investor of a bond over his holding period. So, will YTM and realized yield be the same or different? It depends on whether the assumptions of YTM are valid. The assumptions of YTM are the bond is invested at the current market price and held till maturity. the cash inflows from the bond are fully and immediately reinvested at precisely the same interest rate as YTM. All coupon and principal repayments are made as per schedule. If these assumptions are met, then realized yield and YTM are same. If these assumptions are not met, there is any violation, then the realized yield will differ from YTM. So, first in bond, we discussed regarding risk, and then we discussed regarding return, that is yield. Whenever we talk about any investment, I told you these 3 chapters which we are doing, it is about investment. That is your chapter 4, security valuation, your chapter 5, portfolio management, and your chapter 7, mutual funds. It is all about investment. Whenever we talk about investment, we are looking at 2 things. There are 2 factors that are considered: return and risk. So, the most important risk which we have is interest rate risk. Bond investors, as we have already seen, are subject to interest rate risk on 2 counts. 1, reinvestment. The reinvestment of periodical interest received as and when it is received at the prevailing rate of interest. 2, capital gain or loss. The capital gain or loss on sale of the bond at the end of the holding period. We have already seen when interest rate changes, whether it increases or decreases doesn't matter. When it changes, you will have a loss in one and you will have a gain in the other. Now, as far as you are concerned, you are interested in managing your risk. How do you manage interest rate risk? You can manage interest rate risk by, how can you manage interest rate risk? By computing duration and holding it for the period, the holding period should be equal to duration. In other words, the duration of a bond helps you in measuring the sensitivity of the bond's price to interest rate movements. We are looking at bond volatility. Bond volatility is a measure of the sensitivity of a bond's price to changes in market interest rates. So, when you talk about volatility of a bond, it is like beta for equity. What is volatility for a bond is beta for equity. So you can measure duration. You have the formula, or you can simply use the concept, look at the proportion of each cash flow to the total, then multiply with the year, add, divide by the current market price. That way also we can do, or you have the ready-made formula. Whichever way you do, you would have found the duration. How do you measure bond volatility? Bond volatility will be equal to duration divided by 1 plus YTM. This YTM is the original YTM. When I say 1 plus YTM. And then, if you look at the relationship between, the interest rate and the expected change in price, they are inversely related. Therefore, when you measure the bond volatility itself, you could prefix with a negative symbol so that automatically it will be taken care. Or you could consciously do it when YTM increases, bond price decreases. When YTM decreases, bond price increases. So the change which you have can be adjusted, increased or decreased. So now what I will do, if you are interested in working out the problem, always it helps to have the steps organized properly. So what we will do is, we will find year-wise discounted cash inflows using YTM as a discount rate. As we have already seen, when we take YTM as a discount rate, what we will get is the current market price. We will multiply the year and the discounted cash inflow. So duration will be year into discounted cash inflow divided by current market price. Or you could use the formula 1 plus YTM divided by 1 YTM minus this. So you get the duration. Duration is the holding period for which interest rate risk disappears. Then bond volatility we are interested in finding. Duration divided by 1 plus YTM. Why I have said original is, originally the YTM could have been 12% and then they could state that it is changing by 50 basis points, 25 basis points, something they could say. So when I do duration divided by, I should take 1 plus original YTM, that is before change what was there. Then the expected change in price will be, as I told you, if you want to automatically know whether there is an increase or decrease, you could prefix a minus sign here. Or doesn't matter, you can find the bond volatility. Then the expected change in price. Change in YTM, that is the cost for the change in price, multiplied by bond volatility, like beta for equity. Bond volatility is going to give me the magnitude. So the cost into magnitude into the change in YTM is expressed as a percentage. The magnitude, when you multiply, bond volatility is number of times, it will still be a percentage. But what I want is in rupees, how much is the change? So I have to take the current market price, which is in rupees. So this will tell me what is the expected change in price. Expected change in price will be three things: change in YTM, into bond volatility, into current market price. Expected market price will be current market price plus expected change in price. Expected change in price, if the rate of interest goes up, you have to decrease it. If the rate of interest had come down, you have to increase it. So computation of duration, volatility, change in price, expected change in price, and all is important. If you understand the concept clearly and you approach systematically stepwise, there won't be any issue for you in this paper. So that's it for duration, volatility, and all that. So we should also understand there are two methods which we have seen. One, the long method, where we take year-wise cash flow and all that. The other, the formula. But the formula can be applied only in some situations. It cannot be applied in some situations. The formula cannot be applied to find duration under three situations. One, when the redemption is in installments, that is part redemption in 1 year and balance later. Then when the investment is in installments, then also we can't use. Or the bond has varying coupon rates. First 2 years some rate, next 3 years some rate. Like that and all if we have, we cannot use the formula for duration. Is that clear? Then of course you have the concept of convertibles. Convertible bond, again a very easy thing to do, a question to answer. You know that convertible bonds are bonds that can be converted into equity shares. They give the option to convert into a specified number of shares. Initially, they will act like normal regular bonds. Now there, they might ask you some questions. What questions they'll ask you? They'll ask you for the downside risk. Downside risk of a convertible bond is how much the bond price can decline if the conversion option becomes worthless. So you take the difference between the market price of the convertible bond and the price of a straight or a regular bond. Then conversion premium, they might ask. That is convertible bond versus value of equity shares. That is the premium you are paying to get the convertible bond. And they might ask you for conversion parity price. Conversion parity price means effectively how much is the investor paying for equity by purchasing this convertible bond. So what you will do, price of the convertible bond you will take, divide by the number of equity shares into which the convertible bond can be converted into. Next in bonds, you have what is known as callable bond. Callable bonds are bonds which can be called by the issuer after a particular period. It will be mentioned at the time as part of terms of issue itself that it will be called. Now this is risky for the investor than a non-callable bond because the issuer is going to exercise this option only when the interest rate comes down. Therefore, the callable bonds will compensate the investor for the higher risk by offering a higher interest rate, and also if it is called early, it will be at a premium. So you might be asked to solve a question where they ask you whether the bond, callable bond, whether you want to redeem early, whether it is worth it, like that they might ask you. As I told you already, if we approach systematically, there should not be any problem. This is also like any investment option only. So what you will do, basically, you will see whether this is worth this refunding. As with any investment decisions, you will look at three things. What are the three things you will look at? You will see what is the initial flow, what is the operating flow, what is the terminal flow. Now, when you talk about callable bond, terminal flow would become irrelevant. Terminal flow would become irrelevant because the terminal flow, the time as well as the amount will be the same. So how will you go about it? Means, as I told you, regarding presentation, I will display, we will not solve the problem because the entire subject has to be revised in 3 hours time. So we will not solve any problem, but I will give you an idea as to how to present a problem. Now, let us say you have a callable bond problem on which you want to take a decision. Then how do you go about it? As I told you, as with any decision, you will have three flows: initial flow, operating flow, and terminal flow. So why is the issuer trying to call the bond early? The issuer is trying to call the bond early only because the interest rate has come down and he has a benefit of that. So now, let us say we are looking at a problem. You do not have the problem. I'm displaying this only for the purpose of presentation. I told you at the end of every topic, I'll tell you how to present an answer. So for that, I'm telling you. So now you have a interest amount for the old and the new. Obviously, for the new bond, the interest is going to be less because only when the interest rate comes down, the issuer is going to exercise this option. You will have a tax saving. So the net, how much? You see that. Then you have flotation cost, which can be spread over the life of the bond. For the old, how much? For the new, how much? You see. That you have a tax savings. Then similarly, if you had issued at a discount, the old bond, that benefit also tax savings you will have. See how much it is. Totally, see, after considering the tax savings which you have, how much is the annual cash inflow? There will be a savings because the interest rate has come down. See how much is the saving. So the first thing we have to see is what is the benefit you are getting by calling the bond early, which is the savings and annual operating flow. Then initial flow we have to see. What is the initial flow? You have to redeem the old bond along with premium. For the premium, you'll have a tax savings. So what is the redemption outflow? Then new bond you are issuing, you have a flotation cost. So what is the inflow? Then sometimes this takes time. Redeeming the old bond and issuing the new bond, you could have an overlapping interest that you consider. Then if you go for the new bond, any unamortized portion is there in your discount or flotation cost with regard to the old bond, that tax saving you can have. So initial flow you consider. You have operating flow, you have initial flow. There is one more for terminal flow, but as I told you, in callable bond matter, terminal flow, the amount as well as the time will be the same. So it becomes irrelevant for our decision making. So annual operating flow, I will use the rate and find out what is the present value of operating cash inflow. Deduct the cash outflow. Net present value is positive, accept it. Negative, reject it. So that's it for bond. Shall we go to equity? Coming to equity. Now, equity, it is a combination of what you have learned at the intermediate level. At the intermediate level, you have learned the difference between bond valuation and equity valuation is that bond valuation, the bond we are taking a redeemable bond for a definite period. Whereas equity valuation, it is perpetual. Equity valuation and corporate valuation, it is perpetual. This is the main difference between equity and bond valuation. And when you talk about equity valuation, you have different models which you would have already seen under the chapter dividend decisions at the intermediate level itself. You may have what is known as a two-stage model or a variable growth model, where you have this variable growth or two-stage is applicable for equity, is applicable for mergers, There also when you value corporates. So the variable or high growth you might have for n years, and then you might have a constant growth. So Gordon's model is very important when you talk about any valuation, like that equity valuation also. So let us see variable growth model, how you'll go about it. So supposing you have a growth for a particular number of years, say n years, then you will take how many ever years you have that growth, you will take D1, D2 up to Dn. These are future values. You will discount it at cost of equity. Plus, after this initial period is over, there is a constant growth. You will have the dividend after the initial growth period, divide by KE minus G. This will give you present value of dividend for n years. This dn plus 1 divided by K minus G will give you what is the price at the nth year. But I want P0. So what I will do? Into 1 divided by 1 plus K to the power n. This again is discounting at cost of equity. Is this clear? Then, in two-stage model, we are assuming that there will be a sudden drop. So, because of this unrealistic assumption, you have another model known as Hedge model, where there will be a gradual linear drop. So that is something like this. If you want P0, you will take D0 into 1 plus G2 divided by K minus G2. Again, the Gordon's model of return divided by K minus G is the fundamental model for any valuation. Variations are there depending on what our assumption is. So if you have not a sudden drop, but a gradual linear decline in the growth rate to achieve the constant rate, this is what you will have. We will see more about sustainable growth rate when we come to corporate valuation. So compared to bond valuation, which is new for you at the final level, equity valuation is something which you are already familiar at the intermediate level itself, because you have done cost of equity, you have done dividend decisions. So, as I told you, in our investment, we are going to look at bond, equity, and portfolio management, mutual funds. Now, you may also have questions on rights issue. So, what will you do? In rights issue, you will be asked to find what is the theoretical X rights price. So, theoretical X rights price, you will find as just the weighted average. You already hold shares for which you have the market price. So, market value of shares prior to rights issue you will take. Cash raised from rights issue you will take. Divide by number of shares after the rights issue. That will be the theoretical value. They might ask you regarding rights issue. Or buyback, they might ask you. One very important thing about buyback is because you're using only surplus funds, surplus cash, buyback, the total earnings will be the same. There won't be any issue with regard to total earnings. So that part you will have to take care when you do equity buyback. So what will you do when you look at equity buyback? We are looking at a situation where the earnings will be the same and they will give you the market capitalization after buyback. It's a very easy problem which you will have. Again, let me just display how you can present it. Again, we are not solving any problem, but for the sake of presentation, I can show you what we are doing. So the problem will tell you how much is the surplus cash and how much of it they are planning to distribute. So you will know what is the cash to be distributed. They will ask you for the buyback price. Since we don't know the buyback price, you will assume it to be X. You know the cash to be distributed. You do not know the buyback price. You have assumed it to be X. You can find the number of shares to be bought back. Before buyback number of shares, deduct this. You will get the number of shares after buyback. They will tell you as to what is likely to be the price after the buyback. They may say 10% more, 15% more, something. Definitely after buyback, the price will go up because even assuming the price earning ratio does not change, since the total earnings will be the same and the number of shares would have come down, the earnings per share would go up. So the market price also will go up. So you will have the market capitalization after buyback, equate it, solve. Once you have the buyback price, you know the number of shares to be bought back. And you can give the effect of increase in earnings. Always cultivate the habit of presenting your answers neatly. That will give you clarity. That will also give a very good impression about you to the valuer. So that is the next type of problem which you could have in equity. Shall we move on to portfolio management? Now, in portfolio management, the main thing is the difference. Now, students at times have a difficulty in comprehending or understanding the difference between beta, covariance, correlation, variance, alpha. What are these things? Supposing we don't understand something, we'll say it's all Greek and Latin. So now you have all these Greek alphabets of alpha, beta, and all. What is the difference? Correlation. That there seems to be some confusion. So I just thought, more than anything else, I will explain the difference between these so that you are able to appreciate. The first measure of risk which we come across when we talk about portfolio management or any risk for that matter is variance. What is variance? Variance is a measurement of the spread between numbers in a data set. It tells you how far away the data is in a particular data set. So, variance tells you the movement or change in one variable. It does not capture the direction. So when I talk about variance, only one variable is involved. It tells me the spread between the numbers in a data set. Next, let us take covariance. What is covariance? Covariance also talks about the movement or change, but in two variables. When variance does not capture the direction, covariance captures the direction. Then correlation. What do we mean by correlation? Again, it is a movement or change in two variables. Direction is captured. Strength of the relationship is also captured. Are you able to appreciate how from one we are developing further to get more and more information about what we are analyzing? Variance, it is a movement or change in one variable only. It does not capture the direction because for variance we would have squared the change. And of course, we take the square root to get standard deviation. Covariance means, the name itself tells you, there are two variables involved. Is the movement or change is what I'm looking at? Yes. Is the direction captured? Yes, it is captured. Then come to correlation. Again, am I talking about two variables? Yes. Is direction captured? Yes. What else is captured? Strength is also captured. The covariance is not a very dependable statistical tool for me to look at the relationship and strength of two variables. It is a measure of the joint variability of two random variables. What is the linear dependence between two variables? The magnitude of the covariance depends on the variables. It's not a normalized measure. So, since it's not a normalized measure, I cannot determine whether the relationship is strong. That is why a variation of covariance, a normalized or scaled version of covariance is correlation. The normalization is done using the standard deviation of the two variables. Now in covariance, the unit is a composite unit. Now I want a number. I want a unique number which is going to capture the strength. So in correlation, which is the scaled or normalized version of covariance, the value lies between -1 to +1. I take the covariance, divide by standard deviation of the standard deviation. So the composite cost unit, which I have in the numerator, gets adjusted. You know that standard deviation takes the same unit as the base data. So when I divide by the standard deviation, that cancels and I get a pure number. So when I look at zero correlation, it means they are not related. I can have three situations. I can have zero correlation, I can have positive correlation, I can have negative correlation. Zero correlation means not related. Positive correlation means they move in the same direction. Negative correlation means they move in the opposite direction. Perfect positive means the change in one is a multiple of the change in the other. Negative means the opposite we will have. So unless the correlation coefficient is either +1 or -1. There are other influences, and the relationship between the two variables is not fixed. So, based on the number we have already seen correlation is based on the number, we can decide how strong the relationship is. So we saw it ranges from -1 to +1. +1 means perfect positive correlation. 0.8 to 1 means very strong. 0.6 to 0.8 is strong. 0.4 to 0.6 is moderate. 0.2 to 0.4 is weak. Again. And then how do we go about it? We will take the deviation of each probable return from the mean return. We will denote it as DS. Supposing we are interested in the correlation between the security and the market, this is how we go about the steps. Systematically you approach, there won't be any issue for you in solving the problem. So what will I do? I'll compute the deviation of each probable return from the mean return of the security. Let's say I'm denoting, it's a deviation. So I'm denoting it as D. Yes, because I'm talking about a security. I will take the deviation of each probable market return from the mean return of the market. Again, it's a deviation about the market. So let's say I'm denoting it by DM. I will find the product of the two deviations, DS and DM. I will multiply the product with the probability. So covariance is sigma. This is the capital sigma, stands for summation symbol. P into DSDM. This is the covariance. Now this covariance, as we saw, is not a normalized measure. This is one issue. The other issue is it will have a composite cost unit. For example, if we talk about rainfall and harvest, harvest will be in million tons. Rainfall will be in some centimeters. So if I find the covariance, what will happen is the unit will be a composite unit, centimeter and million tons. So it won't give me a proper meaning. And that is why I want to know the strength. I need a normalized measure. How do I normalize it? I told you we normalize it by taking the standard deviation. I'll just give you a couple of minutes for you to take in this. So now we have a pure number which tells you whether there is a relationship. Is it perfect positive, perfect negative? Is it strong or weak? Okay, now we have correlation. We have yet another measure which is beta. What is beta? Beta, again, is a movement or change in two variables. Here, the direction as well as magnitude is captured. We saw in correlation is a multiple of that number. But in beta, the magnitude, direction is captured, magnitude is also captured. Again, I can have positive beta, negative beta, zero beta. A security that has a beta of 1 shadows market movements, has identical risk as that of the market. Less than 1 means less risky, more than 1 means more risky. Negative beta means the security moves in the opposite direction of the market. Positive means the security in the market, they tend to go in the same direction. 0 means it changes independently. So that is what we have when we talk about correlation. So we know about variance, covariance, correlation, beta. Now alpha, again alpha is used in many ways. There are basically 3 different situations when we use alpha. What are those 3 situations? 1, alpha used for estimation. So this is the regression equation or characteristic line. Alpha here is RS is equal to alpha plus beta into RM, where the alpha here is the return of the security independent of the market return. The return of the security here is independent of market return. Beta into RM, whatever is the relationship with the market, because of its relationship with the market, how much is the return? Then we have yet another alpha. What is that? It's for decision making, where you look at what is the return, expected return over required return. See, alpha means excess. Excess of what over what depends on the context. In the regression equation, it is the return of the security which is independent of market return. In decision making, we are looking at what is the excess of expected return over required return. And for performance evaluation also, we will use alpha, where we say how much is the actual return over the required return using CAP. Then this is the alpha which is used in the regression equation or the characteristic linear equation. RS, return of the security, is equal to alpha plus beta into RM. RM, return of the market. Beta, we know how many times it is in the security as compared to market. So return of the market is the independent variable, return of the security is the dependent variable. So return of the market into beta will tell you how much is the return for the security, which is dependent on the market. Alpha here will tell you how much is independent of the market. Is that clear? Then we also have splitting in portfolio management, splitting the risk of a security into systematic and unsystematic, and splitting the risk of a portfolio into systematic and unsystematic. Security risk, how can we split into systematic and unsystematic? As always, you go systematically, stepwise, there should be no issue, provided we understand the concept clearly. How do you do it? This is how you do it. if they ask you to split a security between systematic and unsystematic, variance gives me the total risk of a security. So I will find the variance of the security. The total risk only can be split into systematic and unsystematic. So systematic risk, that is risk explained by index, it arises because of the relationship with the market. So how can I find it? I can take the security variance and multiply with coefficient of determination. Coefficient of determination means correlation squared. Now always variance is required. So any operation I do with variance, that also has to be squared. Or I can take the market or index variance, multiply with beta squared. So what will I have? I have total risk. I have explained. How will I find unexplained? Total minus explained. Similarly, they might ask you to split the variance of a portfolio into systematic and unsystematic. That is similar, except that to split, what we should do. There are two models we can use to do this. One is the Markowitz model, the other is the Sharpe index model. First, let us look at Markowitz model. I'll have to use the formula to find variance of the portfolio. That formula you know, isn't it? Which is similar to that A plus B the whole squared. Supposing you have two securities for which you have to find the variance, we can use the formula. So that formula you can use and find what is the variance. Find the variance of the market. Portfolio beta. Now, beta is additive. So portfolio beta is the weighted average beta of the individual securities that constitute the portfolio. The investment proportion of each security in the portfolio should be taken as its weight. Then systematic risk. We have seen this earlier. We will take the market variance, multiply with the portfolio beta squared. Unsystematic will be total minus systematic. Similar to what you have done for the security. This is the first model, that is Markowitz model. For this, you need to use the formula to find. Now, the formula for variance would be this. WA squared sigma A squared plus WB squared sigma B squared plus 2WA WB sigma A sigma B correlation AB. This is similar to A plus B the whole square, that formula. When I talk about the risk of a portfolio, that is made up of three things. One, the risk of the individual securities. Two, the investment proportion of each security in the portfolio. And three, the correlation that exists. So that is what we have here. If it is 3, it is like A plus B plus C the whole square. Now, this of course we must have done. So 3 securities means what we should do? We should take like this. So if you want to find for 3 securities, this is what you do. WA squared sigma A squared plus WB squared sigma B squared plus WC squared sigma C squared 2 WA WB sigma A sigma B correlation AB. Like that it goes. Now, 2 securities we can do this. 3 securities also we can tolerate. But if you have, for let us say, 5, 6 securities, then obviously we need to look for something else, which is what we have in sharp index model. So, how do we go about doing the sharp index model? So, what is common between the 2 models? I have to find portfolio beta. I have to find systematic risk of the portfolio. Then, what I will do, I will find the variance of each security, with which I can find the systematic risk of each security. I can find the unsystematic risk. We have already seen any operation you do with the variance. The other thing, since variance is square, the other thing also has to be squared. So the investment proportion also I will square. I will find the unsystematic risk of the portfolio. I will get the total risk of the portfolio as systematic plus unsystematic. What is the difference between Markowitz model and this? In Markowitz model, total minus systematic is unsystematic. In sharp model, systematic plus unsystematic is equal to total. Anyway, for both, systematic risk is common. So is this clear? So now this is done, isn't it? So this is for portfolio management. Now let us move on to mutual funds. What about mutual funds? You know what is a mutual fund? Now, mutual fund, every exam they ask you, and it is one of the easiest chapter. And in fact, I would suggest that you take mutual funds first in the exam also when you get. So whether we talk about evaluation model or we just talk about the return, mutual fund is a very easy topic to do. So I told you, isn't it, first 1 hour choose, in that maybe you would be better off choosing mutual funds. So what is it we need to know about mutual funds? First thing, that there are various investment options that we should know. That is, when I talk about yield, we have already seen yield refers to return on investment. Return is made up of income and capital appreciation. The return for a mutual fund investor also consists of 2 components. The surplus distributed by the scheme, earlier it was called dividend, but SEBI has come out with a regulation last year which says it should be called income distribution cum capital withdrawal. But anyway, till now in our exams for mutual fund, they use dividend. In case they use this, you should know what they are referring to is dividend. What is it called? IDCW, income distribution cum capital withdrawal. IDCW, same as what we call as dividend. Then capital appreciation, which is what? Closing NAV minus opening NAV. Now, there are various investment options and plans. Growth plan, bonus plan, dividend plan. What do you mean by growth plan? In growth plan, dividend, the present name of course is IDCW, will not be declared, bonus will not be declared. So the number of units which the investor has will be the same. He will not receive any dividend, but NAV will keep on appreciating. In bonus plan, bonus will be declared. It is similar to bonus shares. So the number of units will increase, but NAV will come down. In income distribution cum capital withdrawal plan, which is I was telling you dividend plan, there are two variations. Dividend payout plan, dividend reinvestment plan. Dividend payout plan, dividend will be paid, investor will receive the cash. Dividend reinvestment plan, the dividend will be declared, but cash will not be received by the investor. Instead, that amount will be invested in units of the scale. So the number of units will go up. So this is the main thing when you talk about the various plans. Then you have, they will ask you for annualized return, which you will have to compute. Then you have what is known as evaluation, where you have Sharpe ratio, Trainer ratio, and Jensen's alpha. Each one of these talks about return as well as risk. Now let us look at Sharpe ratio. What is Sharpe ratio? Sharpe is the same that Sharpe index we saw, isn't it? Who also invented CAPM, the same William Sharpe. What do you have here? This is one ratio. RP minus RF divided by sigma P. What is RP? Return from the portfolio or the mutual fund. Minus RF is risk free. So the numerator tells you how much extra. Divided by sigma P. Sigma P is what? It's a risk. So this is a return, excess return, a reward which you are taking, which you are getting for the risk taken. So the Sharpe ratio is also known as reward to variability. Next, you have Trainer ratio. Again, RP minus RF. RP minus RF is what? Reward. Excess return you are getting. For what? For taking a risk. What is used as a measure of risk here? Beta. So RP minus RF divided by beta. This is Trainer ratio. Now, apart from Sharpe ratio and Trainer ratio, now Sharpe ratio, Sharpe ratio can be used for portfolio also, can be used for mutual fund also. What's the difference between portfolio management and mutual fund? Portfolio management, you yourself do, or you appoint an investment manager to do only for you. Whereas mutual fund is, they collect from various investors and they pool it for a common objective. That's the difference, isn't it? But anyway, it is an investment management. Now, alpha, we already saw, alpha means excess return. Here also, alpha means excess return. Jensen's alpha, because Jensen was a person who found this. Required return using CAPM, we know, RF plus beta into RM minus RF. Alpha would be if it is past actual return. If it is for future, you want to take a decision, it is expected return minus required return. So Jensen's alpha will be RP minus RF plus beta into RF minus alpha. Is it clear? So these are evaluation models for mutual fund. So my plan was to complete this area investment in 1.5 hours by 11:30 so that we can have a short break and then come back again for Forex, International Finance, Risk Management, that area. So shall we have a short break now? Shall we continue? Now, let us look at Forex and International Financial Management. First, let's start with Forex. In Forex, what is it we have? First, we have two theories. That is, when we talk about Forex exposures, we have three kinds of exposures. What are those three kinds of exposures? Transaction or trading exposure. This arises because of the timing difference between when a contract is entered and when it is settled. So the transaction exposure deals with changes in cash flow that result from existing contractual obligations. You have export receivables, import payables, interest payable, so and other things. So basically, we are looking at some short-term or medium-term exposure here. Then we have what is known as balance sheet or translation exposure. That is, there is a exchange rate fluctuation, currency fluctuation. When a company prepares consolidated financial statements, then it has foreign subsidiaries. The enterprise has assets and liabilities denominated in foreign currency, and for the purpose of reporting, it has to be reported in the domestic currency. So this is your balance sheet or translation or accounting exposure. So if my transaction exposure is the impact of past transactions on income statement, I could say the translation exposure is the impact of present assets and liabilities on balance sheet. Apart from this, we also have what is known as economic or strategic exposure. Any valuation we know is a present value of all future cash flows. What happens when there is a change in the exchange rate, an unexpected change? The cash flows of the company will get affected directly by affecting its revenues and costs, or even indirectly by affecting its competitiveness by the action of its customers and competitors. So the net present value may differ from the one anticipated. So this is your strategic or economic exposure. So when we talk about Forex exposure, we are talking about these three things. There are two theories which we need to know. The first one is the purchasing power parity theory. The purchasing power parity theory is based on the law of one price. That is, if you have the same price for a particular commodity, you take a particular commodity, and all through the world, if you have only one currency, and of course many assumptions are there that there are no transaction costs, there is free competition, all those things. That is what we are looking at in purchasing power parity theory. In other words, what? The purchasing power parity theory is based on the law of one price. If the same commodity is being manufactured in two countries, if of course transaction costs are not there, free trade movement is there and all that, it should command the same price is the base for this. That is the law of one price. So purchasing power parity theory actually relates to macroeconomic variables, the inflation rate and the exchange rate. So the exchange rate between countries is the ratio of prices of some representative commodity or basket of commodities. There is an inverse relationship between inflation rate and currency value. If inflation rate is high, there is a loss in purchasing power. This is purchasing power parity theory. Next, we have what is known as interest rate parity theory. What is this interest rate parity theory? Same logic which you have in commodity market extended to money market. That is interest rate parity theory. What is interest rate parity theory? The interest rate will decide the rate. That is interest rate parity theory. How will you find the price? If you are talking about interest rate parity theory, you can find the forward rate as a ratio of, that is the exchange rate differential is equal to interest rate differential is the idea. If actual forward rate is there, we will take it. Otherwise, we will consider the interest rate parity theory rate as the forward rate. Now, forward, what do you mean by a forward rate? When we talk about currency quotations, you have what is known as cash or ready delivery, which happens on the same day. You have TOM, that is value next day, and you have what is known as spot transaction. Normally, it is understood that spot transaction means immediate. No. Cash or ready delivery is on the same day. TOM is value next day. And spot means within 2 days. When we use interest rate parity theory, how do we find the forward rate? We can find the forward rate. Of course, we have to look at whether it is a direct quote or an indirect quote, which we are talking about. This is purchasing power parity theory. I can find the expected spot rate. Yes, 1 because spot rate, 1 because after the period. This is purchasing power parity theory. S1 is equal to S0 into 1 plus DI divided by 1 plus F5. If it's indirect quote, foreign will come in the numerator and domestic will go in the denominator. This is purchasing power parity theory. By using purchasing power parity theory, you can find what is the expected spot rate. In the same way, interest rate parity theory, we can find what is the forward rate using the interest rate differential. How do we find using interest rate differential? So the base for interest rate parity theory is spot rate and forward rate, that is exchange rate differential, is equal to interest rate differential. If it's a direct quote, forward will be spot into 1 plus RD divided by 1 plus RF. If it is indirect quote, forward will be spot into 1 plus RF divided by 1 plus RD. Their expected spot rate is found using inflation rates. Here, expected forward rate or theoretical forward rate is found using interest rates. Now, what is the next thing we need to know with regard to Forex, forward rate, spot rate? What is the difference? That is what we need to know. What do you mean by a forward? I told you, same day means cash or ready delivery. Within 1 day means value next day or TOM. Within 2 days means spot. Anything beyond that is forward. Then when we talk about exchange rate quotation, we have what is known as bid rate and ask rate. What is bid rate? Bid rate is the rate at which the bank is ready to buy a currency. That is, this is the rate at which the customer can sell the currency. Ask rate is the rate at which the bank is ready to sell a currency. That is, this is the rate at which the customer can buy the currency. Always the bid rate, ask rate is from the banker's point of view. Bid rate will obviously be cheaper than the ask rate. The spread, which is known as the bid-ask spread or exchange rate spread, is the banker's charge because he requires a return on capital employed, transaction cost, then the risk which he is taking, he needs a premium. That is why you have the bid-ask spread. Now, when you talk about a forward rate, the forward rate for a currency may be same, costlier or cheaper than the spot rate. When a currency is costlier in forward, you say it is at a premium. When it is cheaper in forward, you say it is at a discount. Now, the forward rate quotation can be expressed in three different ways. Directly forward rate may be given, or the forward premium or discount can be expressed as annualized percentages of the difference between spot and forward. How I will do this means forward minus spot divided by spot into, now this forward rate will be for 2 months or 3 months, isn't it? I have to annualize it. So I'll do into 12 by n into 100 because I want it as a percentage. Then the difference between the spot rate and forward rate may be expressed in terms of swap points. Swap points, the number of pip points that are added or deducted from the current spot rate of a currency pair to determine the forward exchange rate. What do you mean by pip point? Pip point is the smallest change that is possible. How many points can change? Now I have to observe whether the swap points are given low, high or high, low. Is the first one more or less than the second one in the pair? Then if it is low and high, forward rate will be spot plus swap. If it is high, low, forward rate will be spot minus swap. This is an area where you have to be careful because normally this is an area where students go wrong. Up to this, are you clear? Is there any doubt? Then another area where we have to be careful is, in a currency pair, they will talk about appreciation and depreciation. Now, the appreciation or depreciation in one of the currencies in a currency pair, let us say we are talking about USD INR. Now, if USD appreciates, then obviously INR will depreciate. But the rate of appreciation in USD is not the same as rate of depreciation in INR. This is something which we should know. Are you clear with what I am saying? In a currency pair, say US dollar, INR. US dollar has appreciated. It necessarily means INR has depreciated. Or US dollar has depreciated. It necessarily means INR has appreciated. There is no doubt here. But the rate of appreciation in one currency, say USD, is not equal to the rate of depreciation in the other currency, INR. So what should we do? Whenever appreciation or depreciation in one currency is given, the currency for which appreciation or depreciation is given should be taken as the base currency. That is, base currency means for the currency for which the quotation is given. So base currency will be, supposing the exchange rate is 1 USD is equal to 80 rupees. Base currency is US dollar. Terms currency is INR. So the currency for which appreciation or depreciation is given should be taken as the base currency, and the other currency should be taken as the terms currency. Then the appreciation or depreciation should be applied on the terms currency to find the revised exchange rate. This is an area where you have to be careful. Is it clear? For example, let me just give you an illustration which will help you understand the point which I'm referring to. See, suppose $1 was quoting at 60 rupees. It becomes $1 is equal to 80 rupees. What is the appreciation in dollar? 33.33%. Because what is the change? From 60 it became 80, 20 rupees. Divide by 60. So the appreciation is 33.33. On the other hand, if I look at the rupee depreciation, it is not 33.33%. It's only 25%. Why? You know how to convert one into the other. Here, $1 is equal to 60. If I want to know one INR is equal to how much, I should do 1 divided by 60. Here, $1 is equal to 80. If I want to know one INR is equal to how much, in other words, if I want to convert direct to indirect and vice versa, I should do 1 divided by. Now I find that the depreciation is only 25%. This is what I meant when I said in a currency pair, if one currency appreciates, the other currency necessarily depreciates. But the depreciation in one is not equal to the appreciation rate of the other. Are you clear with this? So this is the next thing we need to know in Forex. So what else? Money market. Now you need to know regarding money market, covered interest arbitrage, money market hedge. That part you should know. Now we are talking about Forex risk. We are talking about hedging. Hedging can be internal or external. Internal hedging techniques, you have many internal hedging techniques. Like you might have exposure netting, you might have leading and lagging, you might have sourcing. You refer to your study material, you have all the techniques. External hedging techniques are money market hedge, options, and those things. So first let us look at money market hedge. Now, any external hedging technique is when you do something extra for hedging. Internal hedging technique means as part of your day-to-day transaction itself, you manage. So, money market hedge is one external hedging technique. What do we do? Let us say you have a foreign currency receivable. One very important thing which we should understand when we talk about hedging is the objective of hedging is to ensure that there is no variation or risk. It is not to make profit. Hedging itself is for fixing the rate. It is not for making a profit. So, if we understand this basic feature about hedging, we won't have any problem. Money market hedge. What do I do in a money market hedge? I have an exposure. Then separately, I have to enter into something else. What should I do? Let us say I have a foreign currency receivable. If I have a foreign currency receivable, am I interested in the currency appreciating or depreciating? Whatever I receive, I should get more. Whatever I pay, I should pay less. So, as an exporter, if I have a foreign currency receivable, I am concerned that the foreign currency will depreciate. I have a foreign currency receivable. Is that an asset or a liability? Foreign currency receivable is an asset. Therefore, I should create a liability to offset this. What will I do? I will borrow a foreign currency loan and I will invest it here domestically. What is the advantage? I am happy with today's rate. I want to have the conversion today, but my customer will pay only later. But I want to convert it today. So what do? I simply take a foreign currency loan, which can be paid out of the foreign currency receivable which the customer is paying. So no conversion need to be taken. I need not exchange the foreign currency because my loan is also in foreign currency. My receipt is also in foreign currency. That original foreign currency receipt can be used to make the repayment of the loan. So that is fine. Now, I have taken the foreign currency loan, isn't it? That I will invest here domestically. Then I'll get interest, isn't it? Together with interest, whatever I'm getting, that is my amount. This is money market hedge when you have foreign currency receivable. What will happen when you have foreign currency payable? I'm an importer, I have a foreign currency payable. What is it I'm concerned? I'm concerned that the foreign currency will appreciate. Then what will happen? I have to pay more. So what do I want to do? I want to pay now itself. How can I pay now itself? Do I have the money? No. So what will I do? I'll borrow domestically and do what? Pay that money. Pay that payment which I have. That foreign currency payable which I have. Then am I worried about that? No. But have I taken a loan here? Yes. Should I pay it? I will pay. So anyway, exchange happened today itself. So I am not worried about the fluctuation. Have you understood the logic behind money market hedge? Next, I am interested in options. As I was telling you, option is also an external hedging technique. Internal hedging technique means part of my day-to-day operation, normal activity. I don't do anything extra like exposure netting, sourcing, choosing the currency of invoicing, leading and lagging. All these are internal hedging techniques. What are external hedging techniques? Separately, something I do. Money market hedge, option hedge, forward, future. These are all external hedging techniques. Now, there will be a premium which I pay for an option. Sometimes we will consider that premium, sometimes we will not consider that premium. So, students have a doubt. When should we consider the premium? When should we ignore the premium? For that, we have to go back to our basics. What is it I will consider as relevant? Or there are, if I have to consider something as relevant, there are 3 conditions that should be satisfied. Now, this concept of relevancy which you are learning is not only helpful for SFM, it is also helpful for SEM. What is it? Relevant costs and revenues. What do you mean? Only thing, if it is SEMPA, we will say cost and revenue. If it is SFM, we will say cash inflow, cash outflow. But concept is the same. 3 conditions are to be satisfied. It should relate to future. Cumulatively, these 3 conditions are to be satisfied. 2, there should be a cash flow. 3, it should change with the alternative. All 3 conditions are cumulatively satisfied, it is relevant, otherwise it's not. So let us see what are all the decisions I take with regard to a currency option. First, decision whether option should be used for hedging. Will the premium be relevant? Yes, it will be relevant because it is future. And if I take, I have to pay. The premium is yet to be paid, there will be a cash outflow. Because if I take the option only, I will pay, it changes with the decision. All 3 conditions are satisfied. So for a decision whether option should be used for hedging, the premium paid is relevant. What is the next decision? I have decided I want to go for an option. Options are available at various prices and various premiums. Which option I should choose? I want to take a decision. Then is the premium relevant? Yes, premium is very much relevant. Again, all 3 conditions. Future, cash flow, changes with the alternative, they are satisfied. Therefore, it is relevant. So when is it irrelevant means I have already bought the option. I have to take a decision whether the option is to be exercised or not. Now it is irrelevant. Why? Because the option premium has to be paid upfront. Upfront means beginning. At the time of entering into the contract itself, it should be paid. If it has to be paid at the time of entering into the contract itself, later on, whether I exercise or not, that money will not come back to me. Therefore, is it relevant? Not relevant. Why? First, it is not future. Already paid, so past. 2, there's been a cash flow, but not in the past, not in future. 3, does it change with the decision? No, it doesn't. I exercise, then also premium paid is paid. I don't exercise, then also premium paid is paid. It does not change with the decision. Therefore, it is irrelevant. So, how do I handle a problem when I have an OTC option? If I can have an OTC option, it means I can have an exchange traded option also. With regard to options, options can be OTC or can be exchange traded. So, how do I go about solving a problem which has options? OTC option, what should I do? I should consider whether the foreign currency exposure is a payable or a receivable. Let me just display the steps for you so that it's comfortable for you. First, let us consider OTC options. Now, options can be either OTC or exchange traded. When you look at forwards are always OTC, over the counter. Futures are always exchange traded. Whereas options can either be OTC or can be exchange traded. Let us first say OTC option. What should I do? I should consider whether the foreign currency exposure is a payable or a receivable. If the Forex exposure is a payable, I have to buy a call option. Call option is an option to buy. Put option is an option to sell. So, if the Forex exposure is a receivable, I will buy a put option. Premium has to be paid upfront. We already saw at the time of entering itself, I should pay the premium. So, what is the amount in domestic currency at strike rate? I have to see. Strike rate or exercise rate is the rate which has been agreed upon under the option contract. The cash flow under the option will be, call means domestic currency paid on exercise of the option plus the premium. Put means domestic currency received on exercise of the option minus premium. For a call, it is plus because this domestic currency I am paying, premium also I paid, so I will add. Put means domestic currency I am receiving, but premium I paid. One is an inflow, the other is an outflow, so I have to net it. Now this premium amount, since it was paid upfront itself, if the problem mentions, you can compound it and bring it to future. Sometimes nothing is mentioned, we will just keep it as it is. We will not look at the time value there. Depends on the problem. Anyway, give a note. Is this clear? Can I go to the next one? So what is the option means this. Now, from the problem, how to identify whether it is an OTC option or exchange traded option means there are some questions which you have to answer. What are the questions you have to answer? Now, exchange traded options means they are standardized. What? With regard to what? With regard to four things. One is, what is the underlying or contract or base currency? All three mean the same. What is it? In the exchange, they are buying or selling. That is the meaning. So what? What is the underlying contract or base currency? How much? Whenever something is exchange traded, you will have a contract size, you will have a lot size. So how many units? Supposing we are talking about US dollar is the base currency, 1000 US dollars is one lot. Anything exchange traded, it will be in lots and you cannot have fractional contracts. So there will be some excess or there will be some shortfall. Then, when is the expiration date? Then, what is the mode of settlement? Cash settlement or physical settlement? What do you mean by cash settlement? Cash settlement means the difference alone will be paid. Physical settlement means actually it will change hands. The asset as well as the money will change hands. Now in currency trade, we will assume cash settlement only. Now, this is exchange traded. So what I should do? I should look at what is the underlying currency. That is the base currency which the exchange will buy or sell. How will I identify means lot size will be specified for that currency only. Now, this is an area where students have difficulty. Now, you must have all worked out. So, I am telling you the important areas where there could be a possibility of a confusion or a mistake. So, how do I find out which is the base currency? Means the lot size will be specified for the underlying currency. That is the base currency or contract currency. So, I have to look at the terms currency. The other currency will be the terms currency. The strike rate will be specified in the terms currency. 1 US dollar is equal to 80 means they would have said lot size of 1000 US dollars. With that I know. See, if it is US dollar rupee, we can very easily find out which is the base currency, which is the terms currency. But if you have USD euro, if you have USD GBP, euro GBP, there could be some confusion. That is why this is how you will identify. How will I find out which is the terms currency? The strike rate will be specified for the terms currency. So, the foreign currency payable or receivable and the base currency, I have to match and see. Then I should decide whether I want a put option or a call option. Then currency requirement in the underlying currency I have to find out at option strike rate. Is this clear? Okay. So next. Now I have found the currency requirement, then what I should do? I should look at the contract size, divide by the currency requirement of the contract size, so that I'll know the number of contracts. As I already told you, number of contracts cannot be fractional. So the number of contracts I have to round up or down. The premium amount I will find out. I will pay upfront. But for the premium amount, spot rate only should be used. Because I'm going to pay upfront. Today, what is the rate prevailing? That is what is applicable. Once this is done, I will look at what is the domestic currency cash flow and the exercise of the option. Since I have rounded off the number of contracts, either up or down, there will be a surplus or deficit. I should consider the forward rate. And then I should find the cash flow. I will be asked whether I will go for forward or money market or option, like that. This is over. So that is all for options. Now options, if you have understood clearly, futures is similar to option. Now I was telling you with regard to the checking of whether put option or call option based on the base currencies. Let me just display how to present such a thing. Let's see what happens. In this problem, if you see, you have a foreign currency payable of Japanese yen. We are doing it from the Indian point of view. It is a foreign currency payable. But in the exchange, the base currency is INR. If the base currency had been Japanese yen, since it's a foreign currency payable, you have to buy Japanese yen, which means it would be a call option. But in this exchange traded currency option, base currency is given as INR, which means what? I can only buy or sell INR. So, had it been Japanese yen, I would have said call option Japanese yen. But here, the base currency is INR. So, what I have to do? I have to select a put option for INR. So, what is the foreign currency payable? What is the strike price? What is the amount payable? What is the premium? How much is the premium? As we have already seen, it should be at the spot rate. What is the total outflow? I'll have to see. Normally, OTC means based on whether I have to pay or sell, whether I have to pay or receive, I can decide whether it is a call option or a put option. OTC means if I have to pay, it will be a call option. If I have to receive, it will be a put option. But exchange traded means I have to see what I have to pay or receive. I also have to see in the exchange what is it they are doing. Are they having this currency as the base or the other currency as the base? Accordingly, I have to decide whether it is a call option or a put option. OTC means I have to pay means call. I have to receive means put. But exchange traded means I have to be a little more careful in deciding whether it is a call or put. Is that clear? Futures is very similar to exchange traded options, except in future, you might have a margin deposited for which you will consider the interest. Again, in future also, like we have seen in exchange traded option, you have to look at what is the base and decide any exchange traded product that is applicable. So for a future, what will I do? Consider whether foreign currency exposure is a payable or a receivable. What is the base currency? What is the currency requirement? Contract size, how much? Here, whether I should buy or sell depends on what is the base currency. After the period, I will close and find the profit or loss. As I told you, in currency, we will consider cash settlement only. Supposing they have given, then that margin money, I have to find the interest. Then I should net off with the original and then find out what is the amount. Is this done? So next, are you clear with the Forex? Next, what we have in store is international financial management. What are the types of problems we will have in international financial management? First is capital investment. Then you have sources of finance. Then you have treasury. These are the three types of problems you will have in international finance. So here, it is very similar to our investment decisions, except here you have a foreign currency involved. So you have two techniques to find the net present value. As with any investment decision, we know the most popular or best method is net present value. So we will find the net present value. But here you have foreign currency involved. So you could have two approaches. You could have a foreign currency approach or you could have a domestic currency approach. So under foreign currency approach, what we will do? Under foreign currency approach, see, even earlier in our discussion, I was telling you, the nature of the cash flow will determine the nature and the timing of the discount rate. If I take foreign currency, I should use a foreign rate to discount. If I take domestic currency, I should use a domestic rate to discount. So foreign currency approach means foreign currency cash flows are discounted using foreign risk-adjusted discount rate. I have to find the risk premium because my domestic risk-adjusted discount rate will be given, and then I'll have to fit it in foreign risk-adjusted discount rate. That has to be used to discount foreign currency cash flow and find the net present value. Convert it into domestic currency because anyway I want to know what is the position, what is the result in my domestic currency. As always, NPV is positive, accept. Otherwise, reject. Just look at this. Give me a minute. I'll be back in a minute. So are you through with foreign currency approach? Next, domestic currency approach. So now, under domestic currency approach, what should we do? Anyway, I have invested in the foreign country. So I will have foreign currency cash flow only. I have to convert it into domestic currency. How will I do that? For me, three possibilities are there. If they give the actual forward rate, I will use it. This is unlikely. They won't give the forward rate. Then, if interest rates are given, I will find that we have already seen this interest rate parity theory, isn't it? We will use that and then I will consider it. For this, the money market rate which they have given, I will apply. If inflation rates are given, then I will find the expected spot rate using purchasing power parity. We have already seen how to find the expected spot rate. S1 is equal to S0 into 1 plus DI divided by 1 plus FI if it is direct, otherwise the opposite. We have seen that. We will do that. Supposing the problem gives both inflation and interest rate, then I will use interest rate parity theory. Then I will use the this thing, but I have to incorporate the risk. So domestic risk adjusted discount rate will be taken and then domestic currency cash flow will be discounted. Again, and NPV is positive, accept, negative, reject. This is the first model in international financial management where capital budgeting. You could have a situation where an Indian company is trying to invest outside India, or you could have a situation where a foreign country is trying to invest in India. Both you could have. Now here we have to be a little careful in converting the using the rates, seeing whether it is direct or indirect. And then supposing you have mixed flows, it's possible that you have domestic currency cash flow also and you have foreign currency cash flow also. Like that, if you have mixed flows, what we should do, we should always follow domestic currency approach. Foreign currency can be converted into domestic currency, but we will not be converting domestic currency into foreign currency. So if you have foreign currency cash flows also and domestic currency cash flows also, we should always use only domestic currency approach. Mostly problem itself will specify which approach you have to follow. Now, how to present such a problem means you can see always presentation is very important. Now let us look at a problem where you have rupee cash flows, you also have rand, African rand cash flows. Now, in this problem, everything was given in real terms. That is, inflation was not incorporated. So what you have to do, you have to incorporate, because what we want is a nominal cash flow. You have to incorporate the inflation to get the nominal cash flow. Similarly, rand cash flows also make it nominal. Then it's an indirect code that was given. So we already have the inflation rate. So we will use the purchasing power parity theory and find what is the expected spot rate. We will get the nominal cash flows both in India and Africa, and discounted rate is there. So we will find the present value of cash flow. As I've already told you, with regard to equity or with regard to any investment in a company and all, it is to perpetuity. So here also it is to perpetuity. So I will find from year 4 onwards, it is the same. We know how to find the present value of a perpetual annuity, which is A divided by R. So A4 divided by whatever is the discount rate. When I take A1 divided by R, I'll get V0. If I take from the 4th year, I'll get at the beginning of the 4th year, which is end of year 3. So I have to further discount it with 3rd year discount factor. So net present value is negative, so not interested. You will observe that entire SFM, maybe except for portfolio management, it's not at all time consuming. For us to consider the correct things and then apply it correctly only takes time. Actual solution doesn't take much time. This statement, even with an elaborate presentation like this, see, it won't take much time. It is for us to consider all this correctly. It will take time. So this is the first model which you will have in international financial management, namely your capital budgeting. What is the next one I told you? The next one you will have is the source. That is whether you want to, how do you want to raise the money? It could be for short term, it could be for long term. Do you want to use a depository receipt route? What do you want to do? That kind of a problem will be there. There, of course, you need to know concepts like letter of credit and then foreign currency convertible bond, depository receipts. Those concepts you should know. That is for source of finance. And then, of course, you could have with regard to cross currency. Now, what is cross currency? Cross currency means, see, there are two possibilities. First of all, normally when you talk about an exchange rate quote is given for a currency pair. The first currency in the pair is the base currency and the second currency in the pair is the terms currency. If I say USD INR, USD is the base currency, INR is the terms currency. So what is the USD INR rate? If you ask, 80, they say, it means 1 USD is equal to 80 rupees. A cross currency rate refers to an exchange rate between two currencies that are both valued against a third currency. I am finding the rate between two currencies using another currency. So cross-currency rate may refer to, I told you two possibilities are there. The currency code between two currencies, both of which are not the official currencies of the country in which the exchange rate is quoted. If I look at in India, USD Euro rate, it is a cross-currency rate because both are not my official currency. This is one possibility of what is a cross-currency rate. Another possibility of what a cross-currency rate is the currency quote between two currencies traded in the Forex market, neither of which is the USD. Now, you know, USD is the global currency against which all other currencies are quoted. You have any exchange rate quotation, if you see, it will be USD with some other currency. So, in my domestic country, cross-currency refers to the currency code between two currencies, both of which are not my official currency. Or, if I go to the Forex market, it refers to the currency code between two currencies, neither of which is the USD. So that they will ask you to find the cross-currency rate. Then lastly, in international financial management, the type of problem which we will say is treasury. What do you mean by treasury management? We know treasury management means planning, organizing, controlling, and holding funds and working capital of the enterprise to make optimal use of the funds. What do you mean by optimal use of the funds? Liquidity should be there, overall cost of funds should be reduced, risk should not be there. So, when I talk about treasury management, I'm talking about three things. I'm talking about currency management, I'm talking about working capital management, I'm talking about financial risk management. Currency management, that is a primary function of a treasury management. Treasury department, their primary function is currency management. So there should be an efficient cash collection process. Whenever I have to pay, funds should be there. I should be able to meet my financial obligations, whether it's to my suppliers or employees or lenders or shareholders, whoever. So when I talk about cash management, there should be an effective collection and payment system in the organization. An optimal level of liquidity should be maintained, which means there should be smooth functioning of the business. Financial obligation I should be able to, but at the same time, I don't want to hold too much cash. So you may have treasury management problems. Now, mostly you will find that when I say I want to manage risk, there are three types of risk. One is in the commodity market, the commodity price risk. In the Forex market, the exchange rate risk. In the money market, the interest rate risk. So, a treasury department should manage these risks. Should I have a centralized cash management for an MNC? Means yes, treasury should be centralized. Now you will find that multinational companies, they have subsidiaries all over the world. So what they do, they divide their global operations geographically. Let us say into three major areas. What are those areas? The Americas. For that, they may have, basically they will have their treasury centers in each of these geographical area in a city where you have a well-developed capital and currency market. For example, if it is the Americas, that geographical location, they will keep New York as the treasury center. If it's Europe, they will keep London or Frankfurt or Switzerland. If it is the Asia Pacific region, They will keep Singapore or Hong Kong or Tokyo. That's what they will keep. So, as we have already seen, these treasury centers will take care of cash and liquidity management. They will also take care of the financial risk management. Working capital also will be taken care by them. Why should you have a centralized cash management system? We have already seen regarding internal hedging techniques also. So this could even come as a theory question for you. I need to manage the liquidity requirement judiciously. If I have a centralized management of treasury, I'll have an overall view as to where I have surplus, where I have deficit, and then maximum returns I can get by investing all cash resources optimally. You may even have questions where they say that so much surplus is there in this center, so much surplus is there in that center. So, do you want to invest in London, or do you want to invest in Frankfurt, or do you want to invest in Amsterdam? Like that, they might ask you questions. So, we have already seen regarding correlation. You can use various hedging strategies optimally and see that you exploit the currency movement correlation. You can pool funds, which means the risk will come down. So for all this, it's better you have a centralized thing. You can set off the intra-group indebtedness. You need not unnecessarily exchange currencies and incur transaction costs on that. So you will have problems like that asking you where you want to be. This center has so much surplus funds, that center has so much surplus funds. Where do you want to invest? They could ask you. For which you need to have this background. You should know what they are talking about. So what I mean by a treasury management Western is something like this. So you can look at it. As I was telling you, every topic we do, I will give you a sample of how to present it. Let us say we are talking about treasury. Then you have 3 centers, Amsterdam, Switzerland, and UK. And you have surplus amount in each of these. So the question is asking you whether you want to invest locally or you want to club everything and invest in London. So locally means how much you have, you will see. Amsterdam, Switzerland, UK, total how much you are getting if you invest locally. And supposing you club and invest, the interest rates will be different. So you will see how much, because everything you are converting into GBP and investing here, your rates will be involved, of course, exchange rates will be involved. This will be the investment receipts. And you have to return to them along with the amount. So what is the net interest you are getting? If you have invested everything here, locally means how much, which is better. Like that, you might be asked a question. So we have done the second block. Now these 2 blocks are actually what you can say are big blocks. Then I come to the other block, which is your corporate valuation and mergers acquisition. There I have 2 concepts to discuss with you. With regard to corporate valuation, I already told you we will discuss the sustainable growth rate matter. Sustainable growth rate means the maximum rate at which a company can grow without having to raise new equity capital or increase financial leverage. So you will see there are basically some assumptions for sustainable growth rate, like your investment policy is stable, your financing policy is stable, your dividend policy is stable, like that. You would have done this even in intermediate. in the chapter dividend decision, where you go for Gordon's model, G is equal to BR. The G is the sustainable growth rate, B is the retention ratio, and R is the return on equity. So, sustainable growth rate. Then you need to know the concept of free cash flow. Free cash flow. Free means after financial commitments towards future investment needs, either to maintain or expand the asset base. Cash means it should not be based on accrual. Any non-cash income, non-cash expenditure you adjust, you consider both capital and revenue. Flow means during a period from operations. So free cash flow for the company means cash estimated to be generated by the company, which flows from operations and belongs to providers of all funds. So what is the cash that the company is expected to generate after setting aside cash required? Free cash flow is important because it helps you to see whether the growth rate is sustainable. So that is why free cash flow is important for you. Then we need to know the concept of corporate valuation. As you have two main methods, absolute valuation, relative valuation. Absolute valuation is you take only that company. You take only that company and you find out. You do not look to other companies. Then that is absolute valuation. Valuation itself, we know, is a process of linking return and risk to determine the worth of an asset. So absolute valuation models, you can have an asset-based approach, or you can have an earnings-based approach, or you can have a cash flow-based approach. Asset-based approach again can be net asset value or book value, can be replaceable value, or can be net realizable value. The problem will tell you which value they are talking about. Earnings-based approach means you would have done this at the intermediate also in accounts, future maintainable profits. You would have done future maintainable profits divided by capitalization rate. So earnings-based approach means it can be capitalization of earnings or it can be discounted future earnings. So in capitalization of earnings, we take the past earnings, adjust it, normalize it, and we find the value as future maintainable earnings divided by capitalization rate. Discounted future earnings, we estimate the future earnings if too many adjustments have to be done. So better to estimate fresh itself. We will estimate the future earnings and discount it. Then cash flow based approach, of course. You will get the free cash flow. You consider the free cash flow to be more reliable because it's not based on accrual. Cash is hard cash. So you do not have any accounting gimmicks there. Therefore, free cash flow. Some prefer only free cash flow basis. So this is absolute valuation. Then we can look at relative valuation. What is relative valuation? Relative valuation means it's an alternative to absolute valuation. Absolute valuation doesn't have any external reference, whereas relative valuation compares to that of competitors or industry average to find out what the value is. There you have what is known as comparable company analysis. You take some other comparable company, find the value of the company, from the value of a comparable company, standardize it using some common variable, sales, earnings, dividend, cash flow, book value, any combination. Or you have what is known as precedent transaction analysis. That is, if you are looking for acquisition, some other acquisition has taken place, similar acquisition. Look at how much value they assigned. And then you will use metrics like Ebitda, EV, and you will do it. So Ebitda and EV. What is Ebitda? What is Ebitda? When you talk about enterprise value is what? It's a measure of a company's total value. I was telling you it's regarding acquisition. So enterprise value is a measure of company's total value in a potential takeover. So you can look at it as a theoretical takeover price in an all cash deal. What is the cash, if this company is to be acquired, what is the cash that is to be given to all capital providers, equity, preference, debenture, everything? Enterprise value provides a better takeover valuation because debt and cash is also considered. So enterprise value will be market value of equity, market value of preference, market value of debt. It is like taking over the entire company. So market value of equity, market value of preference, market value of debt is a cash outflow which this acquiring company has to give. They are taking over the entire business. They'll have a cash balance. So you can deduct the cash because it's an inflow. So what does Ebitda stand for? Ebitda stands for earnings before interest, tax, depreciation, amortization. It's a useful measure because I want to measure only the operating performance. Earnings before interest. So financing decision will not come in the way. Tax. So tax structure will not come in the way. Depreciation, amortization. So my accounting policy will not come in the way. So the value of an unleveraged all equity company will be Ebitda divided by cost of equity. Then I will address debt later. This is with regard to corporate valuation. Of course, you also have EVA, EMVA. What is EVA? Economic value added. How do you find economic value added? See, when I talk about value addition, it is economic value added. You know, economic profits, economic when I use, it is after taking into consideration cost of all resources. So EVA will be NOPAT minus invested capital into weighted average cost of capital. NOPAT is net operating profit after tax. Weighted average cost of capital is applied to the entire invested capital because invested capital is from all sources. Over and above that have I made is what I'm looking at in EVA. EMVA, of course, is market value added. So that much for corporate valuation. Coming to, say, different industries value differently. If you talk about FMCG, the cash flows are pretty predictable. So you might be using for going for a cash flow method. If you talk about as capital intensive industries such as steel, cement, etc., you could go for replacement cost. If you look at banks or financial institutions, NBFC and all, you may go for price to book value. If you are looking at a conglomerate, a highly diversified thing, like let us say ITC, Hindustan Unilever, such companies where they are huge conglomerates which are engaged in various businesses, you have what is known as sum of the parts, chop shop method. Each segment you value separately and then add. You can do that way. So it depends on what industry it is. Of course, the problem will specify what is it you have to do. Then, with regard to mergers and acquisition, which is the last chapter, now exchange ratio. Exchange ratio or swap ratio means the specified number of shares given by the acquiring company to the shareholders of the target company in exchange for a specified number of shares held by them. It will be negotiated based on the value of the target company relative to the value of the acquiring company. So this exchange ratio can be based on value or return or strength. Then, what do I mean by value or return or strength? It can be based on what is the return, that is earnings, what is the book value, what is the market value, what is the balance sheet strength, such as, it can be anything. It can be earnings per share, it can be net asset value, it can be market price, it can be balance sheet strength like capital adequacy ratio. If I'm looking at the plus and trying to fix the exchange ratio will be value as per metric of the target company divided by value as per metric of the acquiring company. If it is based on some weakness, then, or based on risk, I should put value as per the basis for the acquiring company in the numerator and divide by value as per basis for the target company in the denominator. Then if they ask you for the upper limit, lower limit, maximum exchange ratio, minimum exchange ratio, you should look at a situation where the market value of the shares held by the shareholders is not coming down in any way, and then decide what will be the exchange ratio. They might ask for equivalent EPS, which is EPS post acquisition into exchange ratio. They might ask for implied price, which is price per share of the acquiring company into exchange ratio. So, as I was telling you, upper limit, lower limit. Upper limit is always for acquiring company, because acquiring company is the company which is buying. It will set a maximum price above which it will not pay. And lower limit is for the target company, because target company is the company that is selling. It will fix the floor, the lower limit, below which it will not sell. So what is it we have done? What did I tell you in the beginning? What is it we will do? I told you, first we will do the question paper pattern. Let me go back to the PPT and see whether we have covered. So we are talking about time management. We should also be able to start on time and end on time, isn't it? Question paper pattern. Have we discussed? Yes, we have. Have I told you how to manage your time in the exam? Yes, of course, I have told you. And have we looked at time management? Yes. Important problem chapters. Investment, did we discuss? Yes. Corporate valuation and mergers and acquisition? Yes. Did we discuss about Forex, international finance, interest rate risk? Yes. Mixed chapters, of course, 2 and 3 you have to do on your own. And theory chapters, 1, 6, and 14, you have to do on your own. So that brings us to the end of the session. We had 3 hours where we tried to fit in all the chapters and discuss only the important concepts. I'm sure you will all do very well. I wish you all the best. So, Shushmita, are you there?
Yes, ma'am, I'm here.
Yeah.
Are you able to hear me, ma'am?
Yeah, I can hear you. And yeah, all through you were able to hear me properly, right?
Yes, ma'am.
Screen sharing, audio and all okay, right?
Yes, ma'am. Everything was perfect, ma'am. We were able to see the screens. We were able to see the PPT, your tips also, ma'am.
Oh,
thank you, ma'am.
Good, good. So that brings us to the end of the session.
Yes. Before we call it a day, I would like to propose the vote of thanks for this amazing session. Thank you is the best player, says Alice Walker. And we can't thank you enough for the amazing session that you gave today, Shanti ma'am. Because you not just cover about the subject, but you also mentioned the tips and tricks on how we can face the examination, how we can prepare, how we can utilize the 15 minutes of reading time, etc. And you have covered all the chapters in a gist, which will be very useful for us during the examinations. I would further like to thank the students who are part of this session using the YouTube Live, and I request them to be part of the future sessions as well. Thank you so much, ma'am, once again for that interesting and enlightening session. And thank you, SIRC, for organizing this. Thank you so much.
Thank you all. All the best. Bye. Shall we take leave? Bye-bye.